The job market in the United States is experiencing three different shifts right now. Number one is unemployment is starting to rise. Number two is more companies are ramping up their mandatory return to office mandates. And number three is a newer concept called quiet cutting, which is a way for companies to start letting go of some of their staff. So let me break this down by first talking about what's going on with unemployment. This is an article from Wall Street Journal titled "Why Higher Unemployment is Good News Now." That article was published in September 2023 and it highlighted three things. Number one, normally higher unemployment is bad. Number two, this time higher unemployment is good. And number three, higher unemployment is needed in the United States to keep inflation lower. Now, if you want to understand what's really going on, let's understand unemployment from a bigger picture perspective. This is a chart from the Bureau of Labor Statistics showing unemployment in the United States. And between the years 2013 and 2019, you'll see that unemployment in the United States ran between 7% and 3.5%. But things really started to change after the 2020 pandemic. First, we saw a huge spike in unemployment when the economy was shut down. And then almost immediately after, we saw unemployment levels fall to the lowest levels we have seen in more than half a century. Now, I want you to take a minute and think about this. Before the pandemic, we saw unemployment somewhere between 7% and 3.5%. Then the pandemic came in and the entire economy was shut down. We saw the highest unemployment that we have seen since the Great Depression. And then almost immediately after that, we went back to seeing the lowest unemployment levels that we have seen in more than 50 years. What changed? The first bullet point reads that as of March 2021, COVID costs totaled $5.2 trillion, and you can compare that to World War II costs, which were $4.7 trillion in today's dollars, adjusted for inflation. So we saw all this money get created, it entered the economic system, people had the ability to spend money, and businesses had a whole bunch of free money, which allowed jobs to be created at some of the fastest rates ever. And so now everybody had a job. But then we had another problem, inflation. And this is where the Federal Reserve Bank started their ramp-up efforts to fight all the money printing that they did by increasing interest rates at some of the fastest rates that we have seen in many decades. This is where now the Wall Street Journal is saying, will inflation keep sliding towards 2%? If instead it stalls out between 3% and 4%, that means the Federal Reserve Bank will have to raise interest rates even further, eventually inducing a recession. So the Federal Reserve Bank is having to raise interest rates in order to fight off inflation. So the pandemic came, a whole bunch of money was created, all this money was injected into our economy, a whole bunch of jobs were created, everybody had a job, people were feeling good, but then the Federal Reserve Bank had to fight inflation, and they had to fight inflation by raising interest rates. The raising interest rates are starting to hurt the economy, and one of the ways that they're hurting the economy is by hurting the job market. And if inflation cannot continue going lower, then the Fed might be forced to raise interest rates even more, which could push our economy into more pain, which would mean more job losses. And this is where companies and employers are understanding what they're seeing in the economic system, and they're trying to get a little bit more proactive to cut some of their costs or to meet the lower demand for their products. And this is where you're starting to see some companies reduce their job openings, reduce some of their starting salaries, and maybe just hire less people. This brings me to number two, the return to office mandates. This is from Forbes. 9 out of 10 companies will be back in the office by the end of 2024. Now, for those of you who are economic weirdos like me and you like to stay up to date on what's happening with things like the housing market, the job market, the economy, the stock market, and everything in between, that's why I created Market Briefs. Market Briefs is a free financial newsletter that I created to help you stay up to date on what's happening in the economy. It's completely free. You can read it in less than 5 minutes every morning, and it's a super fun read. So if you have not joined Market Briefs yet, I got the link to how you can join down in the description below, or you can go to briefs.co/market. That's briefs.co/market. Now, when it comes to the return to office mandates, what companies are looking for is to maximize the productivity out of each one of their employees. And there are some jobs that work better in office and some jobs that really doesn't matter. And this is where you got to figure out what's the right one for you. Like, one thing that we have learned here at the Briefs Media team is that our hybrid work style does not work. It worked okay, but when it comes to being more efficient, getting things done, being more creative, because we're a startup, we need the team together. And this is where we are going back into the office fully in 2024. We're already doing a hybrid style right now, but we found that when we're together, we're able to get things done way faster, way more efficiently, and come up with way better ideas because we have that startup culture and we need people to be together. Now, other companies, you don't necessarily need that. And this is where now a lot of companies are having to decide, do we need to be in the office or do some people not need to be in the office? And other companies are saying, well, we need to cut some of our costs. And if people are not coming back into the office, well, that could be a reason for us to let some people go, which brings me to number 3, understanding this concept of quiet cutting. Our job market went from experiencing this great resignation to then quiet quitting to now it seems like quiet cutting. And over the last couple of years, I've talked about this before, we've seen a lot of power in the hands of the employee. And in the hands of the employee, they've had the ability to do things like leave and get a better paying job, or quietly quit because they had the ability to. Well, now what we're seeing happen is that companies are needing to be more proactive, or companies are looking at their revenues or looking at their profits saying, oh man, it looks like we're starting to get more tight with our profits. Our margins are starting to fall. Inflation has pushed up our costs. Our revenues have not grown fast enough. We need to start cutting some of our costs. Now, employers could just do mass layoffs, but that kind of comes with negative PR and you don't want to lay off the wrong person. So what some companies are doing is they're saying, okay, how about we only keep the people that want to be completely dedicated in our company? How are we going to find them? Well, how about we only have the people that come back into our office continue to keep a job, and the people that want to work from home, well, if you want your lifestyle, you can leave. And that's what some employers are doing. Now, there's a lot of different ways that employers can do quiet cutting. Another way could be potentially that they give you more jobs, more roles, more things that you don't like. That way they kind of just push you out. That way they don't have to go out and do the layoffs, but it's a way for them to kind of nudge people out the door. That way they can cut some of their costs, because if a company is seeing smaller revenues or smaller profits, they're not going to be able to sustain their current business model. Now, one of the ways that you can cut your costs is do layoffs, but layoffs have their own consequences. So if they can entice people to potentially just leave themselves, then it's kind of a win-win. It's kind of a win for the employer because they don't have to worry about doing layoffs and they can save some costs. And if that employee can find another job somewhere else, well, then that could also be a win for them. Now, if you get kind of nudged out this way, you won't get a severance and you won't be able to file for unemployment. So that's kind of a con over there. But this is where the important thing for you to understand is the shift in the job market. And I want you to understand this. And you can get mad at me for saying this, but I want you to really just understand this. We are seeing a shift in the economy. This is happening all around us. We're seeing much higher interest rates. These higher interest rates have an impact, and that's hurting some businesses' ability to make money. And a business is in the job of making money. It's not in the job of trying to give their employees the best lifestyle possible. Now, it can be beneficial for an employer to give their employees a good lifestyle. That way they can continue performing. But at the end of the day, a business is looking at their bottom line, and they want to make money. That's their job. And so now, when you're starting to see this changing environment, where you're starting to see a slow uptick in unemployment. Unemployment is still historically low, but we're starting to see it slowly rise upwards. And if we continue to see high interest rates, that's going to put more downward pressure on the economy. That's going to put more upward pressure on unemployment. That's going to make it potentially a little bit harder to find a job. And as employers are trying to only keep the best workers, to only keep the best employees, you can bet that it's going to be pickier on the side of an employer on who they want to keep. And so if you're more focused on your lifestyle than you are on actually doing work, it's going to be extremely difficult for you in the coming months and potentially years to maintain that in a company that is struggling financially. And this is where you want to understand what's going on with your company. Are they seeing growing revenues and growing profits in this economy, or are they starting to see higher costs and lower revenues? And if you're in a company with higher costs and lower revenues, either you got to find a company that's going to allow you to continue living your lifestyle, or maybe you want to start putting in more work. That way you can make sure that you can kind of secure your position. Now, of course, nothing is guaranteed, but we are seeing this shift. Before, the power was in the hand of the employee. Now it's starting to become more even. The employee and the employer started to have more of an equal power. And if we continue to see higher interest rates, which would put more downward pressure on the economy, which would give more power to the employer. And this is where now it is important for you to understand what's going on. That way you can continue to protect yourself. I mean, my goal for you is not for you to work at a job that you just kind of want to cruise at. I would like for you to succeed and want to work hard. I mean, why would you want to work at a job that you don't want to really work at? That just doesn't make any sense. Find a job that you can actually enjoy doing, that you can actually succeed in. Find a career instead of just a job. But understand what's going on in the market. That way you can find success in your work and actually enjoy what you do. Because yes, there are companies out there that can be fun and work at the same time. I mean, work doesn't have to be boring.
US News put out this article on what they call the 7 best dividend-paying ETFs that you can consider buying. Here are the 7 ETFs that they recommend, and again, investing has risks. Make sure you always do your own due diligence and never blindly follow a random guy on YouTube. Number 1, SCHD, which is paying out 3.6% a year in dividends. VY